How does implied volatility affect weekly options? Have you ever wondered how the ups and downs of a stock's price can impact your options trading? Today, we are focusing on a key concept called implied volatility and its effect on weekly options. Implied volatility, often abbreviated as Roman 4, represents what the market expects in terms of price movement for a stock over a certain period. It is expressed as an annual percentage but does not indicate the direction of the price change. Instead, it estimates how much the stock price might fluctuate. Weekly options are unique because they have a very short lifespan, typically expiring in just 1 week. This short-term frame makes implied volatility particularly important. When traders look at weekly options, they adjust the annualized implied volatility to fit that week. If implied volatility is high, it suggests that the market anticipates larger price swings in the underlying stock during that week. This expectation increases the premium, or price, of the weekly options. Conversely, if implied volatility decreases, the premiums for these options tend to drop as well. This is significant because weekly options are more sensitive to changes in implied volatility compared to options with longer expiration dates. For instance, if implied volatility rises, option sellers can charge higher premiums. However, buyers will pay more, reflecting the increased risk of larger price movements. Traders need to be aware that when implied volatility declines, the premiums shrink. This can be a disadvantage for those holding long weekly options, even if the underlying stock moves in their favor. The decrease in the volatility component of the options price can offset potential gains. Weekly options are often utilized around major events, such as earnings announcements or economic reports. These events typically cause a spike in implied volatility due to the expected price movements. Traders should note that implied volatility may rise before these events and drop sharply afterward, which can significantly impact weekly option prices. Understanding implied volatility helps traders estimate the potential price range of the underlying stock for the week. This knowledge is essential for selecting appropriate strike prices and managing risk. For example, if a stock is trading at $100 with an implied volatility of 40%, it suggests a larger expected price movement than if the implied volatility were 20%. This difference can influence trading strategies and position sizing. In summary, implied volatility plays a direct role in the pricing and risk profile of weekly options. It reflects the market's expectations of short-term price fluctuations. Traders in weekly options should closely monitor changes in implied volatility to make informed decisions about their trades.